All right, well, I'll just quickly take it from the top in terms of what you need to know as far as markets are concerned. So last week, of course, saw a crunching fall, as I was saying earlier, in the broader markets. You could have seen how many ever corrections, but when you're living through one, it does always feel like the worst. And this definitely is, I think it ranks right up there in terms of the pain that it is causing really out there. Now, this is a graphic I want to spend like a minute and a half on. So the last week changes up on your screen, 7.5% down on the mid-cap index, 19% down on the small-cap index. The year to date, the returns are 9.6% for the mid-cap index down, and 22% down for the small cap index. Actually, the mid cap index is 19%, 19% and 22%. The last one is what I want to spend the time on. Let's just put the graphic back on. The 10-year CAGR return is 14 and 11%. The point I'm trying to make is the falls in the very near term, of course, have been very, very large and very, very sharp. But what this also means is that the 10-year CAGR return for the small and the mid-cap has now reduced to somewhere close to what essentially is the cost of equity, about 11, 12, 13, 14%. Depends on how you calculate it. But, the excess returns, at one point we were running at about 20% plus CAGR over a 10-year basis, which was absolutely unnatural. I mean, the long-term return, 25-year return for, the Nifty, for example, is about 12%, 13%. Now, on a 10-year CAGR basis, I looked at returns 3 or 5 years as well, but just sort of went back and looked at all the way from 2015. That is, the excess froth has come off, and now we are more reasonable on a normalized kind of level, 14 and 11% respectively. So that's essentially what I basically wanted to start with. Now, having said this, it's obviously impossible to look at this and say, well, this is it. I mean, a bottom is here because, excess froth is out of the system. It's impossible to call a bottom. But I think I'd also like to emphasize that there is no real macro risk in India. I mean, if that is essentially what you're wondering, and sometimes price action creates its own narrative. You see prices not recovering, it continues to fall, and we start to wonder, well, is something really wrong? Is something going to come out and the market is responding to that? I mean, there is no real macro risk. It's just sort of selling, begetting more selling at this point in time. Now, FIIs have sold some $21 billion since last October, and they continue to be sellers. But the pace of FII selling has stabilized a little bit. I looked at positioning. Asia funds are now underweight India. Most of our money, foreign money in India, comes from EM funds. Asia funds within that are now underweight. EM funds are relatively and modestly over. They're still modestly overweight. But I mean, the excess positioning is all kind of gone. Now, contrast what's happening in India with the global picture. We are in I think, a clear bull market for global equities. Even as we are suffering this sort of, pain and, big carnage, globally, not just the US, globally things are looking pretty good. The YTD returns will come up. China, 14.5%. YTD. And this is, by the way, the benchmark indices. For China, I looked at the Hang Seng index, 14.5%. Europe is up 13%. US is up 4%. India is down 3%. When I say India, it's the Nifty. So, that's the picture. Countries like Europe, I mean, regions like Europe, if you look at the largest 50 companies in Europe, the Euro Stoxx 50, it's now, in 2025, finally taking out the all-time high from early 2000. So 25 years that index has not taken out the level. It's doing that now at a time where we are, of course, under a fair bit of pressure. So, I mean, again, just to the points, essentially just to point out that globally there isn't very much of a problem. Things are looking pretty good. Now, dollar index is under 107 levels. Early February, we were about 110 levels. You can argue and say that that's largely because, euro has picked up and other cross currencies have picked up. But whatever said and done, the dollar index is well behaved as well. So that's the backdrop. Again, I want to emphasize there's no real science or technique to call a bottom per se, but you can just broadly kind of, look at some of these indicators and say that we've kind of paid the price and we are now running on a normalized kind of trajectory, even though stock-specific things may be different. We'll talk more about that. US markets tonight, just to mention the here and now, US markets tonight are closed, both stocks and bond markets. They'll only open on Tuesday. I'll just put out these levels. Nifty support zone is between 22,620 and 22,775. We kind of hit the lows of January 27th on Friday and then recovered a little bit. Nifty Bank downside level, immediate level to watch out is 48,719. And if you believe that maybe the Nifty Bank is in the process of bottoming out, I mean, the 40-hourly exponential will come into play, which is 49,885. That's the level on the immediate level on the upside to wait and watch out for. GIFT Nifty, I don't think is indicating a bit of a start either way. It's down about 20 odd points to begin this Monday morning. Surabhi.
Yeah, absolutely. I mean, lots to track. I just want to actually start with specific news that impacted Wall Street. At least some set of stocks and stocks that people are really interested in. I'm talking about the semiconductor guys, because over the weekend we had a Wall Street Journal report come out and say that maybe there could be not one but two deals brewing, and Intel could be broken up. And the chatter is that it could be TSMC looking at one part of Intel and Broadcom looking at the other part of Intel. Broadcom looking at chip designing and marketing, and perhaps TSMC looking at the manufacturing operations. I was looking at the TSMC listed stock in Taiwan this morning. It's up about 1.5%. Anyway, the Nasdaq outperformed, the other two indices, the Dow as well as the S&P 500. Things are more or less intact. The retail sales data in the US was not very, very promising. The retail sales numbers for December were a lot weaker than anticipated. But then again, the industrial production numbers were good. So data has been mixed and largely things are chugging along over there. Coming to Asia this morning, Asia is a slightly mixed picture. If you pull up some of the indices, the Hang Seng started really negative. Now it's pulled up in positive territory. Taiwan's actually doing really well, 1% up on Taiwan itself. And the Japanese market is very, very flat. Though, again, it started negative. It's been very volatile and very choppy across Asian markets so far this morning. There's data coming out of Japan, and it's such strong data. The Japanese GDP print is, it's really blown past expectations, 2.8% in the fourth quarter. The estimates were about 1%. The previous number is 1.7%. And even the previous number, Q3, has been revised higher. So it tells us about the strength of the Japanese economy. One theory is that a lot of exports were front-loaded ahead of the tariffs coming through. So that could have aided the performance in Japan in Q4, but really, really strong numbers. And that actually has led to some strength on the yen as well. Versus the dollar, the yen has appreciated almost 0.3%, 0.3.5 the last I checked. Look at that, even more now. Almost a 0.5% move on the yen on the back of such rock-steady, solid numbers coming out of Japan this morning. To talk about the rest of it, the Nifty now has taken support around this 22,800 mark for 3 times. I mean, so people are talking about a triple bottom. Is it finally in place? Is it going to be durable or not? The fund flow picture isn't sort of giving us any further reasons to cheer. Again, FIIs were net sellers on Friday, sold off stock in the cash market worth about 4,300 crores. Domestic institutions offset it by exactly the same number. So it was absolutely net neutral, the institutional flows. But just to put things in context, I thought I'd look at some of the other markets around us as well. Last couple of weeks, what has happened? We have been underperforming, we know that, but by how much is the question? So the Nifty is down 1.2% in the last 1 month. The immediate competition is our neighborhood, which is Hong Kong. Look at the Hong Kong markets, and this is at a time when there's so much of tariff talk. But the Hang Seng has surged almost 15%. But it's not just the Hong Kong market or the Chinese market. Other markets in Europe have done really well as well. The CAC and the DAX are up between 6% to 7.5%. So there's some money that's been shifting to Europe. Let's not lose sight of that. Even the FTSE has outperformed us, actually, if you're looking at the last 1 month. And then, of course, there is the US, which anyway continues to chug along, like I said. The Nasdaq is up almost 5%. And even the broader index, the S&P 500, is up 3%. So that explains the fact that it's not just, you can't just put the blame on strong US, but other markets are also picking in the money. That's the short point. I just want to end by talking about earnings because the season is finally over. And Nimesh has been making this point as well. Maybe it's not as bad as feared, but the numbers are still weak. And these are Motilal Oswal estimates that I put up, estimates and final calculations. 5% on Nifty if you put in commodities and metals. If you strip out commodities and metals, then 7%. That's the earnings growth. It's the slowest in the last many, many quarters. Third consecutive quarter of just single-digit Nifty earnings growth. So those headlines don't look good. And Motilal says the downgrade to upgrade ratio, the downgrade ratio is at the steepest since the first quarter of FY21. And so what is the projection for FY26? The question is, does it get better from here on? Motilal still feels that the overall estimates for FY26 are still elevated at around 15 times earnings growth. So let's see. That's going to be the biggest question, I guess, Nigel, whether earnings can pick up from here on, because we can't control flows.
Yeah.
But if the earnings numbers start looking better, then perhaps we know that there's a bottom in place.
Well, that's right. And Pankaj Tibrewal had made this point that the last earnings season is not as bad as thought. And the Nifty 500 companies, just to wind up, I was looking at a follow-up note. The Nifty 500 companies' earnings growth is 8%, which is better than Q1 as well as Q2.
Yeah.
So that's a bit of a positive. Well, the bulls will be hoping that, this 8-session losing streak comes to an end. But hope's not a data point, right? So let's get you a data point then that I'm looking at. Well, the last time around that we saw 8 straight sessions that the Nifty was down, The following week actually was fairly positive, 3 out of the 4 times. So this time around, what's it going to be? That's a data point that's coming in from Samco, so just thought we'll highlight that. Next up, the markets, yes, they're jittery, but actually fundamentals have relatively, improved. Why do I say that? The RBI has addressed the liquidity issue. Remember, there was a deficit of close to 3 lakh crore in the banking system, which has partly got addressed with the cut, with the OMOs, as well as the swaps that we have seen. The budget is focused on consumption. The benefit of that will be seen in the second half of the year. And also, crude oil prices are lower. There's hope that, that Russia and Ukraine war comes to an end, which will be good for us. The yields are lower in the United States, as well as you have the dollar index that's softened from around 109 odd all the way to around 106.7. So that as well is good news. All those 3 indicators positive. On a valuations parameter as well, I was looking at the Motilal Oswal note, and they're saying on a 12-month forward PE, we are trading relatively more attractive on the Nifty in comparison to the long-term averages. So valuations as well, fairly okay. The FIs, well, they've added shorts yet again. The short positioning is at around 84%. Even in absolute terms, it's the highest that we've seen actually, close to around 1.9 lakh contracts on the short side. Now, the important trigger to track is the PCR. Whenever it moves to 0.65, 0.67, we have seen a bit of a bounce. Currently, it is at around 0.7. And the 2 goalposts should come up for you on the screen. The 23,000 call, well, that is fairly active. The 22,800 put. So looking at the options data, looking at the recent levels that we've seen, we should get this 22,750 to around 22,800 mark up for you on the screen. And it's very, very important because you have gone to that vicinity thrice just in the last 1 month or so, and we have bounced up there. So you don't want this support level to get broken out. If you're looking at resistance, which no one's really talking about because mood is so somber, but otherwise the 20 DMA on the Nifty, the 20 DMA on the Nifty Bank, both those two are reference points. Stocks that I'm tracking, since the dollar index is weaker, we have Hindalco that came out with a fairly good set of numbers. So the markets, ignored it actually. The stock did a relative outperformance, but valuations in favor as well. So I'll keep an eye out on Hindalco and Vedanta. The creditors meet with regard to the demergers this week. So I'll keep an eye out on that as well. So that's one clutch of stocks. The other factor that I'll be looking at is the finance ministers in Mumbai today. So any kind of sound bites, any kind of commentary is something that I'll be looking at. So the mood is a little bit somber, but keep an eye out on the fundamentals. Actually, they've relatively improved. The hope is this 22,750 mark can hold out.